Right, the market started off really strong today. Some good economic data actually pushed the dollar down and yields down, and rate cut odds stayed relatively elevated compared to what we saw yesterday. Was not the same thing by the end of the day. The dollar rallied, yields rallied, and equities fell, especially the small cap index, which for the second straight day has really had a hard time holding a gap to the upside. In fact, pretty significant decline, intraday declines on the small cap index over the past couple of days, kind of defeating this narrative that, from Monday's return that was so bullish on an outperformance basis for the Russell, which was really the only time we've had strong outperformance on the Russell in the last so many weeks, kind of really breaking that in the last couple of days. So, and really it's not even just like Magnificent Seven right now that's driving this market. It's really just the Magnificent Three, right? The three stocks, and especially even this two that are in XLK, as I'll show you today in the sector. So it's like, okay, how do we take this bullishness? Do we ride this trend? Have we seen bullet periods of bullishness like this? I'm going to show you some patterns that we've seen that we're seeing now that we've seen before, and what they meant before, and kind of building upon. I went into a lot more detail on it in our technical analysis class. So for all of our premium subscribers, you can check that out. We had a red flag show up last week on the S&P, and in today's class I kind of showed you that red flag in context of when we've had it before, at other periods of times where it's been a yellow flag, when it's been a green flag, and when it's been a red flag. So which one is it now that we got last week? That kind of I talk about it a little bit here, and I go into a lot more detail in my premium class. But I kind of give you an idea of what I'm expecting to see over the next little bit, and why, and just really how narrow this move has been. And then we'll take a look at a trade, which is kind of might be a little bit of a harbinger of what's to come. So let's go ahead and get started. Today is Wednesday, January the 24th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video over here. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. I appreciate that comment there. Come down to the bottom, click the thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So we always ask. So thank you to those who click these likes day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the intermediate line made its way back above the 90th percentile, now up to the 95th practically percentile here, almost. Though the short-term sentiment's a little bit declining, the momentum line is sitting right around the top end of the reversal zone down here. The near-term line's also dropping, but again, still in bullish territory, so not that significant. We are not more than 2.5% above. We're still kind of below that threshold, as we spent a good chunk of this rally above it. We haven't gotten above it since. So pretty significant from that perspective. The market sentiment now is nearly at the 90th percentile. Again, it's been a long time since market sentiment has gotten to the 90th percentile. If you take a look here, let me get rid of these other lines. There we go. Now you can see again, we don't really ever we got up here in 2020, it got up to the 90th percentile, and again in 2018, it got up to the 90th percentile, and I don't know if those are necessarily the best comparables right here, but again, here we are back up to the 90th percentile, so pretty decent move for the S&P 500. Over the last little bit, and whatever little weakness. I mean, we've had two little near-term declines since the beginning of the year, but that's it, right? We've really they haven't even touched the 30-day moving average in either one of them. When you take a look at the Nasdaq, of course, that's been the biggest driver of this bullishness today, especially the last few days. You can see its intermediate line is above the 95th percentile. Its market sentiment is also near the 90th. And a pretty similar short-term sentiment picture. The diamonds looks a little different. The Dow Jones Industrial Average, after getting a cluster here at options expiration, and the short-term sentiment's a lot more bearish. Its intermediate line's actually still slightly below market sentiment, though both are rising, and the intermediate line's rising pretty quickly. But its near-term line is already out of bullish territory. It's actually in bearish territory there. Of course, your Russell 2000 is even worse. It dropped back below its 30-day moving average today. After starting up, again, second straight day where we gap up pretty significantly to the upside and then do not finish with an up day. The momentum line dropped all the way to extreme lows, and the near-term line crossing back below the intermediate line, with the intermediate line between 20 and 80. A bearish crossover is bearish when the near-term line crosses below that. So especially with the momentum line down as low as it is, suggesting there's a good chance, not 100%, but a good chance that near-term line will follow suit down to bearish levels. After a pretty bullish peak, not really following through on that really bullish peak there. And remember, the intermediate line still actually rising, so we have light green shading. That's why we don't have a bull tag here. But it's still below the chart's midpoint, and continued short-term sentiment to the downside probably would continue to bring that lower. So not the best picture. Pretty distinct picture between the Nasdaq 100, which is strongly bullish, and the Russell 2000, which is, you could argue, still in some phase, early phase stages, kind of like this over here, where you dropped you got the bull tags, you made one last little near-term rally up to the upside, and then dropped back down below the intermediate line while it was below the chart's midpoint. So kind of very similar picture here as to what we're getting here potentially, right? If we'll see if we end up getting more of an intermediate decline like we did when the banking crisis hit. Let's take a look now at the long-term chart here. The weekly chart, again, very strong candle, though not as big as what we've seen when this trend started, but it's still a pretty decently sized candle there. High closing above last week's high, rising PPO looks great, right? The Nasdaq 100 is even better. It's got an even stronger candle to the upside, closing above the high. Everything looking really good there. Not necessarily the same in the other indexes. The Dow Jones has got bullish candles above its moving average down. They're rising PPO, but not closing above the high. Higher close and a higher high, but not as bullish. Still bullish, not as bullish. Not so bullish on the Russell 2000, right? So we do have a bullish candle, but a very small one, and again, not closing above that open there. So not really getting that reversal that we'd really like to see to change this around. And as of right now, again, next week's candle will open up around 1962, and we're currently trading below that. So not necessarily the best reversal pattern there either. From a 3 green arrow standpoint, we don't have 3 red arrows anywhere. We have 3 greens in the S&P and the NASDAQ especially. You have 1 red on the Russell after 1 day of 3 greens. You have 1 red, and then the Dow has been in convergence this entire time. Remember, convergence is when you don't have any shading at all here. So we've been in convergence for a long time on the Dow. Typically precedes consolidation, whether it's consolidation after a bullish move or consolidation after a bearish move. So we'll see if that turns out like that, or if we end up getting 3 green arrows again like we did, which is really, we're only lacking the MACD to get that 3rd green arrow on the diamonds. Looking at the 2 line versions of the chart, the S&P looks great, well above the 817. They're both rising. They're both above the 30. MACD is rising above its moving average, though with weak momentum, wouldn't expect that it would get to higher highs. So you're technically still diverging here because we clearly have higher highs on the price. Same thing with the Qs, though a little bit stronger in that momentum there. The diamonds, not so much, right? The diamonds is actually still below its moving average. That's why we don't have that green arrow on the MACD yet. And then your Russell 2000, you can see, is actually still negative. It's above its moving average. We got a green arrow, barely, but it's still below 0. The MACD itself is below 0, and you're still in the lower half of the chart on the stochastic, as you're back below the 30-day average and sitting right on the 8 and 17 again there. So we'll see. Remember, when you break the 30, you typically fill in the gap to the 200, and we'll see if that ends up being the case for the Russell 2000. The DMI looks great for the S&P, above almost a 40, again already, well below 20 on the negative. The ADX is rising, again, without any kind of consolidation after that parabolic move. The NASDAQ is well above 40, so looking pretty good. Of course, your diamonds not nearly as bullish. So your diamonds here, the ADX is still actually just barely crossing below 40 itself. You are above 25, you are below 20, below 15 on the negative, but not quite as bullish in the short term. Again, IWM doesn't look really bullish at all. Like, you're back below 30 on the positive, you never did cross below 20 on the negative, and your ADX is still falling. So we're still consolidating that parabolic move that we saw here. Looking at the RSI and the CCI, you can see again the RSI above 70 on the S&P 500, well above 70 on the NASDAQ, above 75. Your Dow Jones Industrial Average, it's above 60. It's not over extremely overbought, but at least it's above 60. And then of course your Russell is not even above 60, and it's actually forming kind of a bearish peak after breaking below the midpoint and rallying again. You would expect to get back above 60, maintain the trend, but it didn't. It didn't even get above 60, and now potentially rolling back down with the CCI failing at 100. Those are all kind of signs of weakness on the Russell 2000. Suggesting, remember, that was supposed to be like what was so good about 2024 is the Russell would outperform. It wouldn't be just a Magnificent Seven anymore. It'd be the broader, and we saw that for one day. The Russell had the 1 day of relative strength here 2 days ago. It hasn't had that for the last few weeks. That was the only time it's had that bout of relative strength. The trend strength is almost above 13 on the S&P 500. Again, there's only been a handful of instances that we've been that bullish on the S&P 500. You can see right before the COVID decline and then right here in 2019. And both periods launched, at best, months of sideways action, if not correction. And even over here in 2017, we had some, choppy, very grinding small moves before that parabolic extreme move in 2018. Like, it's not like this is extreme to the upside, and that's the S&P. The Qs remember, had ended its trend. It was already pretty extreme previously, had ended its trend now and starting a new one, and it's right back up to pretty good strength. IWM, not the case, right? It actually started a weak bearish trend, ended that bearish trend, but it's still kind of hanging around back below the blue line. Negative rate of change for the first day on the Russell 2000. All these other days over here during this decline, we still had a positive rate of change. Now it's negative for the very first day. So that's a big change. When we went negative for the first day over here, which would have been, again, it's 26 days forward, that really started the decline. And the same thing over here when it went negative, that really started that decline. And so we'll see if that ends up starting that decline here now that and it doesn't look, unless we get, barring a big move to the upside, we're not going to be positive in the next few days. It would maybe a few weeks if we were to jump from here, but over the next few days, it's really got to jump to even turn positive. So most likely it's going to stay negative. So very significant. We'll see if that ends up dropping below the green line and the blue line itself, plotted back then, which would also be confirmation of reversal. Remember, the S&P is nowhere near that, right? Still very positive, well above these lines, so nowhere near a reversal, which is what, we typically get some weakness once it does cross below zero, that rate of change there. Remember, the rate of change we've already been looking at on a quarterly basis, because we're heading with Tesla tonight, we're heading into the bulk of earnings season. Tesla's already down a little bit, at least it was down earlier a little bit here. But we're well over 15%, 15.5% on a 3-month basis heading into the bulk of earnings season. Again, the last time we were priced for perfection going into earnings, we were nearly a 10% return. It didn't turn out to be a good quarter. So we are really priced for perfection here on the S&P. Even on the 6-month basis, it's not perfection, but it's still pretty decent. If you look at the 6-month return, including that decline there, we're still at 6.5%, which is still a pretty good number. It was a lot higher over here, but that's still a pretty decent number considering that the bulk of it's over the last 3 months. We got to get a good earnings season if we're going to, take this and run, right? Take this earnings and run, keep going. Finally, from a Bollinger Band standpoint, you'll see here that we are again outside the upper band. We opened outside the gap. Like, we've been outside the bands for the past 3 days. We've been outside the upper Bollinger Band. We started today well outside of it too. Closed back below it. as the bands have, with new positive momentum, got green dots again. And the band width is rising in the upper quartile. Of course, a lot of that's the Qs, right? Breaking and keeping going here, and again, well outside the band's width. Much different story in IWM, right? We are not outside the bands. We're in the midpoint of the bandwidth, and in the Keltner channels of the bands outside with that negative momentum there. So much different story, and again, not necessarily the type of breakout move on the S&P, more of a, leads to an exhaustion move when you get these breakouts of those channels when you already are in a mature. We don't know if this is the end of the run. You don't know until you have hindsight. But we do know we already have a mature run, right? We're not starting a new run or a new breakout, as you saw with the SPY. We've had, this bullish run for a long time, so we already have had a good run. And so, again, breaking back out of the band after being in a mature run typically leads to, the type of move we saw, that quarter, where we start to consolidate some moves where we probably got too much return up here and we had to consolidate that. And that's the type of move we're getting again right now. A little bit longer period of red dots than what we had right there, and so far not as much momentum as what we got in that second leg, and we'll see how much longer this second leg lasts. If you take a look at the range, intraday range, of course, a new high, filling in the gap today. We still have the rest of this gap to fill in there. You can see how far above the upper Keltner channel we are, and the band, again, the channel is rising from extreme lows because we're breaking out to the upside. Remember, it's usually we break up to the upside when you already have a pretty decent sized bandwidth, right? That's kind of the norm. So here we're not, right? We're extremely low and we're breaking out to the upside, and that's really not the norm. And as you can see, again, a new high, which means the Arun indicator or the positive indicator is back to 100, as the negative is making its way back to 0, which probably needs to happen. At least the green line needs to get below 70, which in that time your red line probably will get towards 0, closer to 0, before you get the breakout potential of the 4-week range to the downside instead of to the upside. Of course, today's range and volume not really earth-shattering. And filling in the gap, it still ended up being below average, less than 4 points. The volume ended up being slightly below average as well. Again, very, very low range, right? Well, below 1%, very low range. We saw that, extended period of time ending that run there, being below 1%. And the volume is actually higher now than it was then. So, again, that's typical. What is not typical is to be so far above this high point here, with the money flow not above it at all, right? That's not typical. Money flow index rallied, but as of right now would be diverging, right? This would be a considerably lower high point with an easier, much higher high right now. Not necessarily the best sign we want to see. Here you had a good bullish divergence that led into a good bullish move to the upside, and we'll see if this ends up being a bearish divergence. That we've already had one, right? We've already had this series of lower highs with much higher highs. We'll see if this divergence turns into, the opposite kind of move that we saw just right there. The VIX, one last look here at the volatility. Looking at the VIX jumping above 13 by the end of the day today. The VVIX jumping back above 80. Remember, it has been below 80. That's an extreme low for the VVIX. It sets us up for for bullish moves in the VVIX, which is pretty highly correlated with the VIX. So you end up getting, after dropping below all these lines yesterday, closing back up above at least the 30 today. We'll keep our eye on that because, again, there's not much downside to the VIX right now, considering how extremely low we are and how low the 200-day average value of the VIX already. It's almost itself already below 15. Again, that sets us up for, again, where there's more risk to the upside than there is to the downside. Much more risk to the upside than there is to the downside right now. Again, of course, especially with the VVIX, right? The VVIX, as low as it is, being below 80, barely crossing above 80 today. Again, when this is as low as it is and as extremely low as it was yesterday, there's a lot more risk to the upside than there is to the downside when it's already so extremely low. All right, now let's take a look at what's driving this price action here. So let me pull up the S&P 500. Oops. Actually, let's pull up this chart instead. Let's come over here. And then just look at today alone. And you can see we started off really strong because of a drop in the dollar, of a jump in bonds, and commodities being higher really didn't impact things. So that helped the IWM start out the day almost up 1%. International stocks really benefited from the weakness in the dollar. Gold was actually positive at the beginning of the day. High yield was kind of lagging behind bonds. So, good conditions, at least according to current relationships, for the S&P to be positive and the Qs to be positive. Again, less positive than the IWM, but positive. IWM quickly broke down as bonds dropped, as bond yields rallied and bonds dropped, the IWM dropped. Qs rallied, but IWM dropped almost immediately. Real estate dropped there. I mean, that's you can see bonds ended up much closer to the lows of the day than their highs. IWM ended up down almost 1%. Gold stayed down, even though the dollar actually rallied off of its lows throughout the day. And you can see Qs, IW or SPY off their highs. In fact, SPY barely finished positive. So that continues to be the narrative right now, and that's the relationships that are really dominating things. Is the dollar and yields. The dollar, you can see, kind of sitting right around that 200-day moving average, trying to figure out whether or not it's going to peak with this MACD here. That's not necessarily the highest MACD we've seen on the dollar. So I wouldn't say that we have to peak right now. I remember this peak, the dollar peaked well after the MACD histogram peaked. So the histogram is peaking. That doesn't necessarily mean that the dollar's done. It kind of messed around the 200-day moving average over here for a while too before rallying. And that's kind of what we're doing right now. It's above the 50 still. It's above the 8 still. Even though at the lows of the day, we dropped all the way below the 17, we rallied and ended up back above all those moving averages as the 10-year yield made its way and crossed above its 50-day moving average for the first time, closing almost at 4.2% with a rising MACD and a bullish stochastics there. So, and you can see the 8 and 17 have already crossed the 30. And we'll see if we can make a new run up here to the upside as well. Now that we're above the 200. So, again, that was what was so bullish for the markets when the dollar and yields fell, and now we're not falling and we're potentially reversing. Commodities has also been a big factor that of weakness for the risk aversion trade, right? So helping risk appetite increase. You can see we're closed today above the 30-day moving average for the first time, after closing yesterday above the 17 for the first time. MACD is rising, stochastics rising. Remember, you break the 30, you get above the 30, you start to fill in the gap towards the 200 in either direction. And so that would be the expectation. There might be a little hiccup here, but the expectation is you'd fill in that gap, and it's a pretty decent sized gap to get, which would require a pretty decent move to get to the 200-day moving average. Crude oil doesn't need as big of a move, but you can see once it's already crossed above its 50, above the point of control. It's working. It's gradually working its way back up, and that's the three-headed monster: rising crude oil / commodities, rising dollar, rising yields have all been relatively bearish for equities, and part of the reason why that's the case is the impact it has on interest rate hike expectations. You can see if I were to refresh this page here, the odds of a rate cut for March have dropped, right? We're down to 41% now from 47 yesterday, from 90% here. Just right at the end of the year, we were at 90%. So we're really starting to lower the odds of rate cuts starting in March here, and even in June. If you go to the June odds, you can see the odds of a rate cut are still at 100% of just one. And two, the odds of 2 cuts a month ago was also 100%. Now it's only 83%. And then, of course, the odds of 3 cuts, so March, May, June, have fallen down to only 29%. A month ago, it was nearly 90% that we'd get 3 cuts. So you see how things are changed really rapidly. And that's, as yields rise, I personally think that this will eventually hit 0 in March. And I think actually this one, at least for the 1 cut, there's, we're at 100%. It's unlikely that we'll get that we won't get a cut in June, but I don't think we'll get a cut in March or May. Right now, the odds of a cut in May are 83%. I think that's going to hit 0 too, and at maybe in June we get our first one. though I think that's a lower probability myself personally. So as you know, the markets rally, that parabolic move at the end of the year really really happened because of the extremely strong move in interest rate cut odds that pretty much were at 0% odds. They fell all the way to 100. I mean, they rose all the way to 100 for those cuts. This is the odds of just the green would be the odds of just one cut, right? Having just one cut, which you can see is the inverse of that 14%, so that's 86%. Just at the end of the before this really started, October 31st, the odds of just having one cut was not very high. It was only about 14% odds of having just one cut. And obviously now it's at 86. So that's why the market rallied so much. And I think there's a good chance this green line works its way back up, as it's spent quite a bit of time above 80. I think it's probably going to get itself back above 80 again by the time all is said and done here. Let's take a look at the sector moves, and the sector moves is really fascinating. I know we had that one day where the Russell outperformed, and a lot of people kind of hanging their hat on that one day as, now we have a lot of breadth, right? Things are looking really good. But here is the relative rotation graph, and you can see XLK really is the only sector that's outpacing the S&P right now. I mean, XLC kind of is too, but not a whole lot of momentum. Everything else is moving down to the left. So it really is these mega cap names that's moving the markets. If you take a look, here's the main 7 and what they're doing, and they're all moving up to the left, except for Tesla. They're all moving up to the left, and that's been the story, and that's the main driver of this action. But it's not, it's having a negative impact on breadth. You can see we're back down after jumping up yesterday. Or Monday, when we had that good day of breadth, we're back down to 360. We're well below the average, which is not bullish. This hasn't been updated yet. It needs to be updated for the NASDAQ composite, and most likely will here by the time the video gets posted. But just from the New York Stock Exchange, which is mostly large caps, we have pretty good new highs. I would venture to guess we'll be probably a lot closer, if not below 100, when the NASDAQ composite gets updated here. So we'll check on that here later tonight, and again, there are people that are concerned about the market environment, this rally here, and that's the options traders. The skew has made its way back above 145 with some pretty strong momentum here, as you can see relative to other peaks. It's a pretty decent move to pretty strong levels with a pretty strong momentum. Those don't typically last, and the skew drops when the market drops, pulls back. So there's not a whole lot of other people believing this rally either, and we see that across, but especially with the rotation as XLC has such strong momentum. But if you look at all the 12 grid, XLK and XLC to a smaller degree, this with less momentum, is really the only thing that's driving higher. Everything else is at best converging, if not already in the beginning stages of intermediate decline. One of those stocks that is in intermediate decline is Toll Brothers. As you can see, Toll Brothers, its intermediate line is crossed below its market sentiment, is close to crossing out of bullish territory after a couple pretty bearish short-term swings, both lines dropping, crossing below the intermediate line here and then crossing below it again after short stints to the upside, getting a couple bull tags. This bull tag, we bounced up. This bull tag, not so much today. Continuing to follow through to the downside. As you can see, we are sitting now on the 50-day moving average, but that gap between the 30 and the 50 is a pretty sizable gap, especially with very little momentum or very little volume, like a very poor margin of safety here. We can really easily fill that in as the MACD has gone negative. The stochastics has gone negative, or is in bearish territory there. If you look at some of these other oscillators, the DMI has turned around. The negative is crossed above the positive with the ADX already above 25. That's why it's gone dark pink there already. So that's considered a bearish crossover. Sorry, the stochastics. Let's take a look at the RSI and the CCI. You can see it's dropped below the chart's midpoint, well below minus 100, below minus 150 on the CCI. Looking at the Ichimoku cloud, we had a very strong trend that has now ended, We are filling in the gap to the cloud with a pretty, and the rate of change has just turned negative for the first day there, and will probably stay negative barring a significant move to the upside. And you can see the Bollinger Bands and the Keltner channel, the band width is starting to ramp up here as we're pushing against that lower band, and we haven't got the green dots yet. We're probably another day or two away from what may be the beginning of a bearish decline, right, with green dots. So that's something to keep an eye on. So what I decided to do here was say, okay, well, let's take a look at its options and let's do a relatively aggressive, because of that lack of margin of safety, that lack of volume support and that big volume gap. We got a little aggressive with our long put vertical spread. Sold the 85, bought the 90. You can see what it looks like here. About a 4-to-1 reward to risk ratio. Let's get it to. There we go. About a 4-to-1 reward to risk ratio, and you can see not a whole lot of flexibility. It's got to move now for us to be able to get to that reward. But you can see that even if we just kind of move a little bit, what kind of reward we can get in the short term relative to the $500 or less we have at risk, depending upon when we ultimately get out of this, if it doesn't go down. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, remember to subscribe to our YouTube channel. Click that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.